Another very interesting chart this is courtesy of the Case-Shiller Index and the New York Times. You'll see that except for the depression in here, that home values basically had an equilibrium value right in here, except for the housing bubble, which suddenly took off here like this in the 2000s, reached a peak way above equilibrium here, and now has fallen back about half of the way. But as they note, most bubbles not only go back to where they started from, the equilibrium point, but they overcorrect because they develop such a velocity on the downside that they go usually past the equilibrium point before finally recovering to the equilibrium point, which is another argument among many that could be made that the economy is at best going to struggle from here. There is no real sustainable recovery in the cards because the consumer is responsible for 70% of GDP, and their home is by far the largest asset owned by the average consumer. Here's housing starts, and during the 2000s, it's estimated that over 1 million jobs were contributed just by the construction industry. And if you count in related industries, it's even much larger than that. But anyway, here's housing starts, and as you can see, starting in 2006, right at the peak of the housing market, housing starts fell dramatically and have not recovered. Now here's a very interesting chart which I've put together for you to try to demonstrate that in an inflation process, volatility increases. For instance, let's say we had a big stock market crash right here. Would that be the nullification of the inflation process? Would it bring it to an end? No, it wouldn't, because the Fed would inject many more trillions of dollars into the system and raise it up once more before the next cycle. And for instance, the crash of '87, let's say that was in here somewhere. If you look at that on a historical chart, it hardly registers at all. It's just this little blip. And yet the stock market fell 22% in one day. But Greenspan, who had just recently taken over the Fed in 1987, put in a lot of money and drove the economy and the market back up. So this is what happens. You get this increasing volatility because just like a drug addict, you need larger and larger doses. Whenever you hit these or start to hit these bottoms here, which can be market bottoms or recession bottoms or even threatening of recession, the central banks start pumping in more and more money, driving it up until to the next bubble, until you get the next crash, which then they drive up to the next bubble, which then you get the next crash, the next bubble, and so on, until you reach a point where the system simply can't sustain itself anymore. It has too many maladjustments. There's too much debt created by too much funny money, and the inflation leading to hyperinflation all becomes too much, and the system crashes for a final time until you get a new money. It's worth pointing out, too, that every hyperinflation is also simultaneously a Great Depression because the currency itself breaks down, which means business itself basically goes into free fall. And basically things just come to a halt until the new money supply can come in. If the new money supply is simply the old money supply with some zeros lopped off, the process simply continues as before. The public is not fooled, and it only stops when the new currency is backed by gold. And then the public believes it. Then you can have you're starting from a very low bottom at that point, but at least you can have a sustainable progress upward that can last for decades, actually. So again, I wanted to point out that using that previous chart, if we would actually be seeing this kind of thing, like in asset prices, we'd be seeing this here. And in the real value of those assets, we'd be seeing them like here, like this. But it's a herky-jerky stop and go. The Fed actually becomes alarmed, or the central bank actually becomes alarmed after a while at what it's doing, and it's beginning to see the harm that it's causing. But the public starts clamoring for more money. As you go down this path here, the public wants more money, and they clamor for that. So the process continues. Intense political pressure is put on the central banks increasingly by the government and the public to create more money. And so you go further and further into this end stage process. This is a cover from The Economist, and it is indeed true. Because more and more money has been added to the system worldwide over, but especially in the U.S., over a period of 30 years, and the handmaiden of that increasing amounts of money is increasing amounts of debt, which means increasing amounts of leverage in the system, which means increasing amounts of vulnerability and fragility. The system becomes more and more prone to a crash, as we see here, becomes more and more prone to a crash, whether in the economy or the market or whatever, and then as it crashes, more and more money is added to the system to take it up to the next top until the whole thing finally comes to an end. And it comes to an end when you reach a point here where this is basically rising exponentially, this is falling exponentially, and the whole thing just basically can't be sustained anymore. Here I want to show that two things also happen in an inflationary process. Two sectors become monstrously large in an inflationary process, and that is the financial sector and the government sector. And here we see what they're calling the real economy, but actually it's the nominal economy. This is not adjusted for inflation. So it's just simply the nominal GDP. But notice that the financial sector has been climbing at a much faster rate and taking a larger and larger percentage of the economy. The only difference between now and the earlier stages of the process in the United States is that we're now approaching the beginning of the end game, which looks like it will play out almost any time in the next few years. How can you protect yourself? Basically, commodities of all types, from precious metals to base metals to basic materials to energy to farmland, hopefully bought on dips. Finally, I would say prepare yourself spiritually so that you know that your ultimate security doesn't come from money in the first place, but from the divine power residing in each and every one of us. In closing, I'd like to read you a few lines by Rumi. He was a mystic from Persia and Anatolia in the 13th century AD. The dark thought, the shame, the malice, meet them at the door laughing and invite them in. Be grateful for whoever comes, because each has been sent as a guide from beyond. That's all for today. May every possible good fortune be yours until we meet again. Bye-bye now.